Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, Jim, and a sunny Friday morning we're enjoying. So,
Bob, we have 3 questions we're going to base today's show on from our listeners. Our first question is from Tony Viega. Tony asks or says, Jim, I enjoy your network and find it informative. Would you please ask Bob if it's possible that the world central bankers already have implemented modern monetary theory?
Tony, that's a good question, and thanks for sending it. Modern monetary theory has buzzed around in the last year because the left in the U.S. has endless ambition, and they think that it all can be accomplished because the Federal Reserve, all it has to do is print money. And, the Federal Reserve was intended to print money at the start. Not directly, but they did understand then in early 1900s that if you had a setback in the financial markets, it was often followed by a recession. So the theory was that Federal Reserve as lender of last resort would prevent financial setbacks, and that would prevent recessions. And all you can say is there's been 18 recessions since the Fed opened its doors for business in January 1914. So here we are, and all it is a rejigging of the old theory that if a central bank creates credit, all will be well. And of course it isn't. I think the market forces here, when we go into the next contraction, it will overwhelm any attempts by the Federal Reserve to keep the party going by injecting credit. But timely question.
Bob, of course, can you tell us about the invention of, say, the U.S. Fed, which was supposed to prevent financial collapses?
Yeah.
What's happened since they were invented?
Well, as I said, there's been 18 recessions. And if you go by the great American physicist, Richard Feynman, he says in his line goes that no matter how brilliant the proposer of the theory is or how excellent the theory looks, if it doesn't work in practice, like in experiment or over time, if it doesn't work, it doesn't work. And this is the whole thing about intrusive central banking, such as we've had in the States for more than 100 years, is that it does not work. And it's sad that there's no really critical media to take it apart virtually every day. But perhaps on the next correction in the financial markets and in the economy, such critical efforts will be made, you know. I mean, all you have to do is put their boast against what actually happened. So it'll be fascinating to watch.
Now, I believe it was Martin Armstrong who told me that he was people were trying to recruit him to some major American universities who admitted to him that the monetary theory, the financial theories that they were teaching to these so-called financial gurus, the theories were flawed, and they wanted him to give some lectures or be on staff to correct him and tell him how the economy and how finances really work. But he said he didn't want to waste his time on a bunch of pimply-faced 19-year-olds.
Yeah, I like that. But these theories, that an injection of credit from somewhere date back, the earliest I found was in the 1618 to 1624 was a very severe crash in Northern Europe and in England. And then a writer at the time, Edward Misselden, did write a piece, I think it was published in 1622, and he was quite moved by the hardship of high unemployment and stuff like that, and said that, all would be well if there was a fund of credit to create extra credit. And that's the trouble is intellectuals, virtually every century since have come up with the same theory. And it's always intuitive. It becomes personal. And there may have been others earlier than that, but I never found anything earlier than 1622. But every century you've had somebody say the same sort of thing. And the most ironical one was at the height of the bubble in 1873, is when then the editor of the Economist, Walter Bagehot, who was highly regarded, and he published a huge book on money and interest rates called Lombard Street, and in it he pointed out that a recession, a contraction, could be prevented by the central bank providing all kinds of credit out of nowhere. And at the end of that bubble, it was followed by a severe contraction. And in England, it was very severe. And by 1884, the economists in England looked at the unrelenting contraction and said, it's the Great Depression. And they analyzed it as the Great Depression, and it ended in 1895. But as late as 1939, British economists were still analyzing the Great Depression. And then they looked out and said, here's a real one here now. So the market's history, Jim, and the history of intellectual thought is always a wonderful source of irony.
Well, if just printing more money was the solution to everything, then the Weimar Republic in Germany must have been terrifically successful, because it cost millions of marks just to buy a loaf of bread.
Oh, yeah. Yeah, that one, if you were on the right side, like on gold and the stock market, they performed very well in that inflation. And but as things are, most people in the game that they're playing and making lots of money, and they can't anticipate the reversal. So, and then when that inflation in currency stopped, there was a whole lot of speculators got hung out to dry.
We'll have more listener questions when Bob Hoye returns.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, you have two questions from Michael. Michael asks, the defensive sector, specifically utilities, consumer staples, and REITs, have been on a sharp uptrend this year. They look a bit overextended to me. How defensive will the defensive sectors be when the everything bubble blows up?
Oh boy. Good statements there. Buying defensive stocks has always been a fascination for me, because there are fund managers who, if they're looking after the equity side, that's their game and they can't step out of it. So when they see a possible decline in the stock market, they'll shift over to defensive stocks because they might go down slower than other sectors. So I don't see it. Mind you, for a trader, you can often have a rally in defensive stocks going into what could be a pretty good sell-off. So a good question, and the markets will continue to instruct.
Michael also asks, can silver be considered a defensive sector in this late market cycle, and will it continue to be a safe haven like gold in the post-bubble contraction?
Yeah, that's another good one, yeah. No, in going into bad times, silver underperforms gold, and this is where actually the gold-silver ratio, as we joke, is the metallic credit spread. So in a rally for gold and silver, of course, silver will always outperform, so the ratio goes down, and then its distinction is when it starts to reverse with the gold-silver ratio going up and the financial party is still on. So it can warn, actually. So and also, even just volatility in the gold-silver ratio is anticipating a change in the party. So the fact that the gold-silver ratio has been up recently is not an error. It's the way the silver market works. So if we go into contraction, silver would underperform gold, and I'd expect silver stocks would underperform gold stocks. But then they're all vulnerable to a setback in the big stock market anyway. So, but thanks for the question.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, we have a question from Justin Berkeley. Justin asks us, is Bob hanging out by the exit doors with the dollar index at 99.40 as he writes this? It appears to be associated with liquidity issues again. Are there other ratios that Bob follows to track liquidity, margin call stress, and corrections such as junk bonds versus high-grade bonds?
Yeah, that's a good one. Yeah, you always have to be with the party, and the line is you dance close to the exit sign so you can get out. And this, of course, is what we're looking for. The dollar is always a source of confusion, and many commentators learned their concepts in the 1970s when, yes, the Fed was evil, the Fed was going to print money, and commodities and gold and silver would go up forever. But they didn't do enough homework to realize that you can get a whole change where in one decade it'll be inflation in commodities and gold and silver, and then the next decade it'll be in financial assets, stocks and bonds, where we have been. So now we're seeing, or at least until recently, there was some strength in industrial commodities, and gold and silver have been acting well, and this then brings back all the old inflation juices that, oh, this is it, we're finally right, and inflation's going to come. We all know the Fed is insane, and commodities, including silver, are going to go to the moon, but I'm afraid not. If you look at the history, you have and the best way to look at gold is in real terms, adjusted by the consumer price index in the senior currency. And the pattern has been is that gold's real price goes down in a financial mania. And it did this time. The last high was in 2011 when that huge speculation in precious metals blew out. And then we can say that in 2018, gold's real price, as adjusted by the CPI, was building a base. And then in the last year or so, it has definitely set an uptrend. So this one is fitting in with financial history. So the other part of financial history gets us back to the question about the U.S. dollar. And this is what will confound the gold bugs and silver bugs, is that in a post-bubble contraction, the senior currency goes up. Its purchasing power improves, rises relative to most currencies and most commodities. So this can be explained by that during the financial bubble, a large portion of the debt is written and due and payable in U.S. dollars into New York. So the that portion of the debt bubble is actually a short of U.S. dollars, because those U.S. dollars have got to be paid off for debt into New York. So, and then the other thing you have in a post-bubble contraction is that the money, serious money, goes to the most liquid items, and that's gold. And it's also treasury instruments in U.S. dollar. So you'll have a bid for gold, and you'll also have a bid for the dollar. So this is where, in U.S. dollar terms, the price advance in gold may be limited, but in other currencies you're going to make money, which has been the case. But with the gold's real price going up, Jim, it reflects profitability in gold miners. And when it goes up, it's profitable. So this is where we're looking for the long bull market in the precious metal sector, particularly for gold, based on a post-bubble deflation. So again, it gets back to the U.S. dollar, is that at the moment, the gold and silver bugs think they really got it because the dollar is going to crash and gold and silver are going to go up. But our view is that the next phase, once the bubble is over, is asset deflation of all the bubble games. So, but out of the storm comes the gold sector. So, it's going to be interesting to see how it works out, and there will be terrific opportunities in gold stocks, and our technical work will be pretty good at identifying those opportunities as they come in. In the meantime, the sector is acting well.
Bob, thank you so much for being on the show.
Always good to be with you, Jim, and hey, we're looking forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Bob welcomes your questions at info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter at Howe Street. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.